Let's say John, for example, does not know anything about investing. He doesn't know what are the stocks, how stock market works, how to analyze companies, and find out great stocks. So instead of risking his money, he can just buy a stock of the ETF that invest in certain index, for example. Now, one of the most popular ETFs are the ones that invest in the S&P 500. Now, if you take a look at the US economy, you will realize that it consists of a lot of companies. So what are the top 500 companies? And that's what the S&P 500 is. In order to be part of the S&P 500, the company should meet a certain criteria, which is why when we take a look at the S&P 500, we know that these are the top 500 largest companies in the United States and the most successful companies. And the list gets updated every single year. The companies that underperform, they leave the S&P 500. And the companies that outperform can join the S&P 500. So when you buy a stock of the Vanguard S&P 500, you're buying a small fraction of the total top 500 companies in the United States. So no matter what happens, no matter which company goes down, you know for a fact that most of these companies will go up. Most of these companies will perform fine, even though that a few of them will go down over the long run anyways. And that's easy to verify. If you just zoom out and take a look at the S&P 500 historically, you will realize that the average return annually was around 8 to 10%. Just take a look the return for every single year and divide it by the number of the years, and you will come to the number that is around 8 to 10%. Let's say you have $1 million and you invested in the S&P 500. You can be confident that your investments will make around 8%. 8% out of $1 million is $80,000. That's really great passive income. If you're making $80,000, that's about the median salary in the United States. And if you make that kind of passive income and you live in a cheap city, and if you live outside the United States in any of those cheap countries, you can comfortably live a great life without worrying about money at all. But here's the problem. Markets are not stable. You cannot expect your index to perform around 10% every single year consistently. So it's not really as passive as you think, because you have to withdraw your money very carefully. Because if you withdraw too much and you withdraw from your principal, then your money will start decreasing. While if you strategically withdraw just enough money, just the interest that you make on your money without actually withdrawing the principal, then you can enjoy the passive income of your investments indefinitely. You can indefinitely receive $80,000 every single year from your investments. So by buying a share of the S&P 500, you're buying a small fraction of the top 500 companies. Here's the problem with the S&P 500. You don't really get cash on hands. It's not like the S&P 500 will send you a check of $80,000 every single year. That's not how it works. You're not getting your money unless you sell your investments and realize your gains and pay your taxes. Now, that's the biggest problem. And because the markets are unstable, I mean, today it could be up, tomorrow it could be down. Like, for example, 2022 was a negative year, but 2020 and 2021 were really great years where the S&P 500 grew by around like 20% or something like that. So if you want to turn this into a real passive income source, then you have to strategically sell your assets in such a way that you don't touch your principal. So instead of selling 8% of your portfolio every single year, it's better to sell around 4%. Why 4%, you may ask? Because you have to factor in multiple factors. We have something called inflation. Inflation will eat your money alive every single year. Yes, now inflation is around like 4%. And just like last year or the last 2 years, it has been around 8 to 9%. But the average inflation rate is around 2%. So if we deduct 2% for market fluctuations and another 2% for inflation, we'll end up with around 4%. So if you're investing $1 million, then counting on anything more than $40,000 a year is really not possible. I know that 4% doesn't sound impressive, especially if you're starting and you barely have like a few $1,000s. And you're thinking, if I save like $100,000, then 4% is like $4,000. That's barely enough to pay my rent for a single month, leave alone for the entire year. It doesn't sound like financial freedom. But you have to understand that the true rich people have worked super hard to build that portfolio. So they already have like a portfolio of many, many millions of dollars. Some of them have a portfolio of $10 million, for example, and 4% is like what, $400,000. That's enough money to provide you with a luxurious life. Or let's say you have invested $20 million or $100 million. That's what the true rich people do. They know that it's difficult. They know that it's hard. It will take time. But they understand that the reward at the end of the tunnel is the true financial freedom that they have so desperately wanted. The only way to destroy that wealth is when you start spending the principal. I mean, the people who build that fortune in the first place never spend the principal. But once they pass that wealth to their kids or their grandchildren, these grandchildren who did not work hard for that money start spending not just the interest, but the principal, and that's how wealth disappears over time.